Good afternoon. Let's talk a little bit about money management and why it is so different in the derivatives markets like futures and options versus the traditional stocks. I think the biggest difference is just coming into the game. Most people don't spend the time in understanding the vehicles that they're interested in trading, whether it's the financials, whether it's oil, whether it's gold, whether it's the grains, natural gas, etc. They all have a different means of trading. They all trade on different exchanges in many cases. They all operate and have different hours, not necessarily 24/7. And you really need to think a little bit about how you're going to play the game, whether it's day trade, whether it's swing trade, whether it's a little bit of both. And then kind of cut up the portfolio of your trading account and how you want to manage that. It's much different than, say, a stock world because of the leverage is so great when it comes to the futures marketplaces. It's a good thing and a bad thing. The reason why people and many retail brokers really shy away from telling people to look into futures is because they don't understand the leverage, and therefore they don't understand the risk associated with it. However, if you do understand it, they're much more liquid and much more transparent than stocks. So you're able to get out and transact and do business on a much broader and longer scale as far as liquidity and transferability when it comes to futures over stocks, and really the same over options. Options have a very limited time frame that trade, pretty much mirroring equities in that space. And even in the futures, there's options there that are not as liquid as, say, the futures themselves. They don't trade in the same hours that futures do in the extended hours. So a couple things to keep in mind is you really need to understand when you get into the game. Let's just say you have $100,000. Do you want to define your risk at 1%, 2%, 3%, 5%? It really is up to the individual trader and how long you've been trading. The beautiful thing about futures is with that size of an account, you can trade very successfully for income without trading very big size, say one or two lots, whether it was the ES or the NASDAQ. You could, I would also even consider trading into some of the greens. Now, the risk and understanding money management comes into play a little bit more when you look at gold and oil. Now, these vehicles are very volatile, much more volatile, especially recently in the last half a dozen years or so, than the NASDAQ or some of the other financials. So you got to really keep in mind and understand the types of products, and before you can really establish your money management rules, you kind of have to work backwards, and that's one of the things that I like to do. So again, pick a number or a percentage of your portfolio that you're willing to risk on any one trade. Stick with that. And again, if you haven't traded before, you should probably trade much smaller than you will build up to as far as your overall risk. So this doesn't mean that you can't trade a little bit wider. It just means your size has to be smaller. And it's a good way for people to get comfortable in managing appropriate size and managing appropriate risk and carrying overnight positions. The good thing about trading is you can put good till canceled orders. When it comes to futures, you can put bids as far as the limits on the sells and the offers, and bids on the at market, or using the limits, which we tend to be limit traders ourselves. So it's really not, if you can be patient and develop a system of managing how much risk you want to take, you're really going to come into the game well understanding what the risks are. If you don't do this, don't play this game. It's due to the leverage that comes into the trading of the futures, it can be detrimental. However, if you understand the risk associated, setting up the money management first will then lead to future successes. So make sure you understand the vehicles before you even get into the game. Make sure you understand when they trade, how they trade, what exchanges. If you don't understand rollovers is when it comes to futures, and they all have different rollovers. So you need to understand that grains roll over differently than the financials, and oil rolls over different than the grains and the financials. So they all have different means of trading. It's not as simple as buying, selling Apple, buying, selling Google. You really need to sit down and understand the playing field and developing your money management rules before you even get into the game. If you do this, the liquidity and the transparency and the tax advantages that are associated with traders trading futures markets are much better than any market in the game that I've been involved with. So consider this, establish your money management rules, work backwards, top down, if you will, and really figure out where you want to play, how you want to play, and then define your money management rules from there.